Welcome to the Crypto Teacher. And guys, you know I come back with that second video just to make you think. And this is probably the most important video that I've ever made. Even though I made a video on Libor before, nobody really got it. But now you have the CFTC chairman speak about Libor. If you have my New World Order book, you know about Libor. The London Rothschilds, how basically they were just making a phone call and changing the percentages. And when you're talking about $200 trillion, a penny is a lot of money. And that's what was going on. So basically, Libor, derivatives. So you're talking about every loan across the board, your car loans, your house loan, your school loans, everything is in this. And this was an unbelievable scandal that never hit your news media. Now, when he's talking about SOFR is going to be the Fed's secure Libor. But what he's not talking about is a Maribor, which probably will be on Ethereum, and it is unsecured. It's going to be the gambling casino that you cannot see. And he did not speak on it because he's not allowed to. But the fact is, guys, we know blockchain, everything will be tokenized, and they will have finally total control. Guys, I need you to educate and spread this video everywhere. This is a very, very, very important video. Like I said, this is the most important video that I've ever made, guys. $200 trillion is on the line. Educate your friends and family, and guys, y'all have a wonderful day.
And today I thought it may be most useful if we just start out with the big picture. And in fact, it is a big picture. So what's the deal with this Libor transition? Well, number one, Libor is going to go away at the end of 2021. How important is it? Well, there right now are 200 trillion financial contracts that are priced according to Libor. 200 trillion with a T. So what does that mean? That means 10 times the US GDP. That means 10 times the S&P 500. So there are two aspects to the Libor transition that I really want to hammer home. And the first is this. When you are talking about $200 trillion of financial contracts that are priced according to Libor, and Libor may go away, if there is no alternative for that, ladies and gentlemen, we are staring down the barrel of what could be a financial Chernobyl. That's how big of a deal it is. That's how big of a deal it is. Now, that said, there's good news. I bring you bearing good news today, and that's that we've done everything we can to potentially to mitigate that risk, that there will be a situation where all of a sudden we'll have $200 trillion worth of exposures that will no longer be able to actually be calculated and valued. So that is the good news, and we're going to talk a little bit about that going forward. At the same time, when we look at the cleared markets, we are doing a one-step switchover from sort of a floating rate base that used to be Libor, now it's federal funds, but we're switching over to SOFR at some of our big clearinghouses, particularly CME and LCH, and that is going to be done in mid to late October. So those are the two big picture things that I think if they're done in the next 30 days, then we have significantly reduced the possibility of any major systemic risk coming from Libor ceasing to exist. And it is very important, too, that I would say that one of the things that we worked on an awful lot on, and I want to credit ISDA here in particular, is the idea that we would have both a cessation trigger and a pre-cessation trigger. So what do they mean? All right, bottom line here is one of them worries about Libor itself going poof and going away. The other trigger, however, looks at a unique situation, which is some have termed zombie Libor, where you actually have Libor not going away, but still being there despite the fact that the FCA has declared it unrepresentative. So in other words, it's dead from a regulatory standpoint, but it's still alive from a market standpoint and the kinds of issues that would cause. So we wanted to make sure that when the ISDA protocol is out there and written, it allows both triggers to take place. And I would just add, Tom, that I agree with you fully. From my perspective, the issue is how do we address the potential systemic risk of LIBOR going away and the transition to an alternative rate, whether it's SOFR or whether it's other alternative rates. I think, we remain neutral in that point, provided, as you mentioned, that whatever alternative rates are out there and that emerge don't have the same kind of problems that LIBOR had. But, we're very much looking forward to a market solution. We want vibrant derivatives markets, and so we certainly have no objection to additional alternative reference rates coming to the fore and being used. Our focus is really on making sure that when LIBOR goes away, we're not jumping into the sea. There's some kind of lifeboat there.
Well, this week, the story's been 30-year bonds. As they sit, they're down 20 basis points on the week. They were down over 25. Historical, all-time, forever even, low yields. And this contract was introduced exactly 42 years ago today. Happy 42nd birthday, 30-year bond futures. And Richard Doc Sandor right here is the man who wrote the specs for the contract. Congratulations.
Thank you, Rick. It's great to be here with you.
But, Doc, that isn't even the story today.
Right.
The story today is you wrote another contract that's being launched today. Why don't you tell us about it?
It's a substitute for LIBOR, Rick, and it's a hat for you. Ameribor futures are being launched today, and it's a LIBOR replacement. $200 trillion of assets have to be repriced with this new index or SOFR.
Now, the Federal Reserve also has a competing product, and of course, it's called the Secure Overnight Financing Rate, SOFR. What's different about Ameribor, your contract being launched today?
SOFR is fantastic. It is a risk-free rate, and therefore is different than Ameribor, which is unsecured. Rick, it's back to the days of the TED spread.
For those who don't remember TED spread, it's Treasuries versus Eurodollars, secured versus unsecured. And there's going to be arbitrage there, and then you'll be able to read some market signals on credit quality.
Yes, and I think we're going to have a family of benchmarks, just like we have with crude, just like we have with stock indexes, just like we have fixed income. The days of a single benchmark for the entire world is a civilization gone with the wind.
LIBOR, the London interbank offered rate, is basically set to retire, forced retirement due to questionable pricing. That's in 2021. The issue was that the groups that priced that contract, which Eurodollars converged to, maybe we're fudging it a bit. What will prevent the underlying index of your contract to have a similar fate?
Ameribor is a market-based solution to an index. It's not set, it's not a call around, it's based on actual trades on the American Financial Exchange between many, many different banks.
And my final question is, last I looked, there were a boatload of financial structures, even things like mortgages, that are still tied in pricing to LIBOR. Is the lead up to this, with all these contracts still active, is that going to be bumpy, or have our regulators and the Federal Reserve done an adequate job to taper us into this new era?
I think the regulators have done a great job. This is the same scariness that people said about Y2K. It came and went without a flutter. The Fed's doing a great job. The big banks are getting prepared. We're preparing the regionals. And I think it's going to be Y2K. We're going to get there. The day will flip.
Richard Doc Sandor, good luck in your new contract. We all still use your first contract.
All right, well, a massive change is coming to financial markets in 2021 when LIBOR will be phased out. So what options might investors have for re-benchmarking? Well, just about everything. Ameribor may be a solution. Ameribor is offered by the American Financial Exchange, and its CEO, Richard Sandor, joins us now to discuss. Brian Chung also stopping by for the conversation. So, Richard, I guess let's just start with, what is Ameribor? What do we need to know about this benchmark that I think many of us may not have heard of before?
It's a weighted average of interbank lending that occurs in a given day. We have 127 regional and mid-sized banks and 1,000 community banks. So it's really a market-based benchmark, which LIBOR was not.
So Richard, LIBOR, it's going away in 2021. It's been, basically scandal-ridden in the past few years, which is a reason why it's being phased out. For those that aren't familiar, it's a key transmission mechanism for, central banks to kind of get their interest rate targets out there. It's also used to benchmark instruments like swaps and also collateralized loan obligations and whatnot. Now, you serve mostly community banks, is that correct? Why is that? And, how is that different than maybe what the Fed is proposing as its own alternative?
Two things. We represent regional mid-sized community, and what distinguishes us and why we started this venture is it was amazing to me in 2011 when the scandals broke that America, the world's largest economy, did not have its own benchmark. How could it be that a $20 trillion economy was having rates set in London by 18 banks calling each other?
Yeah.
Chris. And so we trademarked Ameribor, we filed for a patent and said, let's get an American-based benchmark, and one that's not a poll. Remember, Libor was like electing the U.S. president by a Wall Street Journal poll, okay, as opposed to having an election. You had 300 million a day trading that called for pricing on $200 trillion based on 300 million and a poll.
But Brian,
And all innovation, industrial inventive activity, financial inventive activity, interest rate swaps, financial futures, junk bonds, mortgage-backed securities have a 10-year gestation period. Markets have to be built. They're not like spontaneous combustion. And this means educating the accountants, educating the lawyers, educating the treasurers, educating the ALCO committees, going to academic conferences, having it introduced in MBA programs, speaking to 23-year-old graduate students who, by the time they're practicing, they've learned about it in college.
it's exhausting.
Let me just basically say how impressed I am with Ethereum, full stop, period. And that when I think about this as a regulator, I think of it almost analogized to email versus the internet. If Bitcoin is email, a one-trick pony, so to speak, but obviously revolutionary, Ethereum goes far beyond that. It's more like the internet.